doing business in Africa, you can't afford to be without Africa Investor.
Net zero. In a relatively short period of time, this term has permeated into climate discussions, boardrooms, and everyday language. It's a term that, quite frankly, until a few years ago, I had little understanding of, and now it's on my business card. Good morning, my name is Chad Richards, and I'm the Director of Net Zero Partnerships at the Nuclear Innovation Institute, and I'm pleased to be here this morning to introduce an exciting panel discussion on investing in net zero. At this moment, the COP26 conference in Glasgow is into its second week. If this conference has shown us anything, it's that taking conversations about reaching net zero carbon emissions by 2050 and mobilizing leaders and businesses around that target is no small feat. This is despite the fact that the world appears to have collectively agreed upon the scope of the challenge we face. It's essentially a straightforward math problem that seems to require a simple solution on the surface. The problem, our world is warming due to the carbon that we've been emitting into the atmosphere. The solution, achieve a balance of emissions that equals zero by either emitting less, sequestering or drawing more emissions out of the air, or both by the year 2050. And that's the essence of net zero. The complexity comes in how we get there as 2050 inches ever closer. For Bruce Power and the Nuclear Innovation Institute, we have a key role to play as enablers, leaders, and catalysts in our drive toward a net zero future. By its very nature as a non-emitting source of electricity generation, nuclear power is an enabler of a net zero economy. In Ontario, Bruce Power provides our economy with 30% of its power in the form of carbon-free electricity. And as we look to increase levels of electrification in the years to come, a clean grid becomes even more significant. We also see a key role for nuclear to be a leader when it comes to net zero operations. That's why Bruce Power has committed to being a net zero site by the year 2027. This accelerated and ambitious timeline for greener operations demonstrates our belief in the importance of leading by example in our drive toward a net zero future. And through this commitment, we're working within our region, in our province, and in our country to serve as a catalyst for decarbonization by investing in technologies and techniques that will help other sectors work toward net zero. Through our Carbon Offset Coalition and other initiatives to produce Made in Ontario decarbonization solutions, we've identified opportunities to fund projects that will make a substantial difference. Namely, strategic partnerships with organizations working on carbon sequestration projects in agriculture and new technologies that can turn organic waste into stable forms of carbon. Right now, there's no safer bet than investing in a net zero future. Increasing the level of investment and opportunities to green our economy is truly a critical part of reaching net zero and saving our planet from the catastrophic effects of a changing climate. That's why the COP26 conference has been so uplifting and yet disappointing to watch. At the same time, we're seeing positive steps forward, like global firms representing $130 trillion worth of assets commit to meeting Paris Agreement goals. We're also seeing infighting around some of the basic tools that can be employed to get us to net zero. The truth is, we need historic levels of investment if we're going to have any hope of reaching net zero. And we shouldn't dismiss any potential solution, from robust carbon offsetting programs that encourage investment in projects that sequester and eliminate the use of carbon, to existing and emerging sources of energy generation. All options should be on the table. Think of the Earth as a patient awaiting emergency medical treatment. The diagnosis has been made, the procedure's been identified, but in many ways, the medical team is still stuck figuring out who should be in the operating room and which tools might be needed. If we're going to get serious about net zero by 2050, then it's time to pack all the best minds we can into that operating room with all the possible tools at their disposal and get to work. With that, I'm pleased to welcome Mr. John Yearwood, Global News Editor at Politico, as the moderator of this important panel discussion on investing in net zero. Thank you.
Thank you very much, Chad. We have quite a bit to get to, so we'll get started. But first of all, let me say good morning to those of you who are joining us here in the audience, and good afternoon and good evening to those of you joining us from around the world on the World Wide Web. First, let me introduce our panelists. First, Eric Usher, who is the head of the UN Environmental Program's Finance Initiative. Hubert Danzo, who's chairman and chief executive officer of the Africa Investor Group. And with me here in the studio is Jane Abatur, who is the sustainability executive for BNP Paribas. Please help me welcome all of our guests. As I mentioned earlier, we have a lot to get to, so I'll start to some extent picking up where Chad left off with our guest talking about COP26. Although it's ongoing, we know that people like Greta Thunberg has said that COP26 is a failure. I want to know if our guests agree, and I want to get your sense of where things are about a little over a week into COP26. We'll start with Herbert, who I believe is just back from Glasgow.
Thank you very much, John. That's a great question, and thanks very much to the organisers for this invitation. I think my response to that would first of all be to give some consoling words to Greta, and sort of tell her not to be a little bit more patient. We have a week to go. Today's Adaptation Day. I would ask her not to throw the baby out with the bathwater. You know, we have to realize that it is quite difficult to host a summit during a pandemic, and, you know, in many respects, progress really has been made. I mean, we're seeing public acceptance of climate change has never been higher. You know, 100 countries have signed up to deforestation by 2030. 45 countries have signed up to the Sustainable Farming Initiative. There's the reduction in walking away from coal investments overseas, although personally I would like to see the running towards renewable investments rather than the walking away from the coal investments. And I think an unprecedented participation of private capital, global pools of capital, took place last Wednesday. We all took part in that great meeting during the finance track, where commitments at an unprecedented level were made. In excess of $130 trillion were committed to net zero. I mean, that's essentially 5 times the size of the US economy. You know, we now know that, and I won't steal Eric's thunder, but the UN is setting up a net zero panel for non-state actors, and of course business is going to be playing a major role. So if you sort of combine that and you look at just the commitments from last week, according to the IEA, you know, those pledges, if met, you know, really still keep us under a sort of 2-degree scenario, and we have the rest of this week to go. However, on the not so good side, and perhaps where I might sort of align a little bit more with Greta, or at least sort of understand her frustration, are the broken promises around, you know, the trust deficit that's sort of being created around the just transition, adaptation and mitigation finance pledges, which are, for example, for my continent, asking Africa, which represents 3 to 4% of cumulative global CO2 emissions, to forego the development of our $15.2 trillion of proven fossil fuel reserves and resource endowment in return for a share of the not delivered $100 billion per annum high vintage adaptation and mitigation finance promise. So certainly, you know, Greta may have a point there. Trust does need to be restored. And the private sector in particular should be on guard, because the conversations that were taking place last week in Glasgow demonstrate that there seems to be a shifting of that sort of political responsibility and commitment around the, you know, the 100 billion per annum, which UNCTAD says should really be closer to 300 billion to 500 billion a year, being shifted to the private sector. But in closing, I think the good news overall is that private capital is now firmly at the table. And interestingly, I think based on the conversations from last week in Glasgow, we're actually at the forefront of pushing governments to take out that political duration and currency risk away, so that we can, you know, have our capital enabled to provide some real support and take advantage of some of these financing opportunities to support the transition, especially to emerging markets and developing countries. So I'll leave it there, John.
Great, thank you, Herbert. Before we go to Eric, I want to come to Jane. Jane, what do you think? Mixed reviews?
Yeah, look, I think that was a fantastic summary of kind of what's gone over the last week. I agree there's a lot to be optimistic about. I think that, the IEA coming out with this conclusion that, the current pledges get us to 1.8 degrees is a really positive signal. And we're a partner of an initiative called the Inevitable Policy Response, which is a kind of a group of kind of economists who are looking at forecasting possible scenarios around the transition. And they have one formal forecast policy scenario that was released a few weeks ago, and they also actually forecasted 1.8 degrees is kind of the current trajectory that, the current kind of will and package will get us on, which is a whole lot better than it was about a year ago or 2 years ago. So definitely we're seeing progress. I think just one thing to add in terms of the roundup is that I read that I think 90% of global emissions currently are now covered by some type of net zero pledge. So they're not all net zero by 2050. We saw India just came out with a pledge net zero by 2070, but a net zero pledge nevertheless, which I think gets us on the right track. When I think we started the year this year, it was about a third or less than a third of global emissions. So from 30% up to 90% is a huge improvement. But I agree with Greta to some extent as well. There is a little bit of blah, blah, blah. If you read some of the commitments, there are some loopholes, there are some outs, there are some big question marks. So I think we need a little more detail on some of those things. And I think in particular this week, the discussion about Article 8 and some of the rules around carbon offsets and trading will be a really important thing to watch as well.
Thank you, Jane. Eric, what do you think?
I would share my fellow panelists' view. I think most importantly, there's no question any longer about the direction of travel. All parties to the convention, so countries are more or less agreed on the direction we need to go, essentially to net zero. It's more just a question now of timing, how fast, speed and scale, and the details to show that we're actually moving. But we're no longer arguing about whether we need to move. I think a second observation is that, what's happening outside the negotiations is probably as important as inside. And I think, to Jane's point, we have now somewhere around 90% of global emissions are under a net zero pledge coming from governments, $130 trillion in the financial sector under a net zero commitment. So we've got the public sector, we've got the private sector who are setting commitments. Then now, so the sense of direction. Now what's needed is actually to deliver. And I think this comes back to the criticality to Greta is the devil's in the detail, and essentially people who put their cards on the table. Now, essentially, you need to actually show that you can do it. And I think that comes to there's a lot of skeptics out there saying the private sector making commitments is glorified greenwashing, and there's a lot of skeptics about country commitments. And I think the reality is it's not one or the other, it's both that we need. And every private sector commitment that's made reinforces government ambition to act, not to sit back and say, the private sector is doing this, but actually to lean in. And good regulation, we believe, comes when the private sector first voluntarily shows how these markets should develop, and that reinforces the ambition and the determination of government to then lean in. And climate risk disclosure is probably the best recent example. Out of the Paris in 2015, out of the Paris agreement was the establishment of the Task Force for Climate-Related Financial Disclosures, which under the G20 was a voluntary initiative. Private sector has started to disclose. Governments have watched this, and the breadth of disclosures has increased. Most large corporates disclose today, so it's a good development. But we have to acknowledge that the depth of disclosures in terms of their comparability, the quality of disclosures are not quite where they need to be. And now governments are stepping up and saying, okay, we're going to start mandating how these disclosures will be done because we want to improve the quality, the comparability of these disclosures. This started in New Zealand, then the UK, EU, now even in the US and the SEC, we're essentially realizing that this is no longer something voluntary, no longer blah, blah, blah. This is firm, how markets will be regulated. You will need to disclose on your climate risk. So good progress there. However, going from disclosing on climate risk to aligning with the net zero trajectory is another big step up. And I think we're still at the earlier phase. Governments, corporates, financial actors are all starting to put, I would say, commitments on the table, but a lot of work needs to be done to level up those commitments to essentially get the follow through. We're at the starting line. We've got the starting gun, but now we need to get moving.
Well, Erica, let's stay with you for a minute, and I want to pick up on that because I want to get a sense of what are some of the things that UNEP is doing to help drive this net zero ultimate goal, and also what kind of reaction have you been getting? Been pushback from others?
Yeah. So I think many have heard about Mark Carney announcing on the GFANZ 130 trillion. The GFANZ is an umbrella set of alliances. So it's an alliance in banking, in insurance, and many parts of the financial system. UNEP Finance Initiatives ourselves, we convene the three of the larger of those alliances, the Asset Owner Alliance, which was the first to launch in 2019, and then more recently the Net Zero Banking Alliance and the Net Zero Insurance Alliance. There are others. There's an alliance of asset managers, and then there's also alliances of different financial services involved. To give two concrete examples, the asset owners, so the big investors like CalPERS and Allianz and AXA, today it's $10 trillion of investment under management from this group of 60 asset owners, so insurers and pension funds principally. They have issued already, everybody's talking 2050, that's fine as the end goal, but the reality is, what are you doing today? And so these investors are in the lead, and they've already, in the lead up to COP, issued their 2025 interim targets, all which are in the 25 to 30% emissions reductions across the portfolio range down. Quite significant in just 4 or 5 years' time. The Banking Alliance, which is probably the largest, I believe, depending on how you compare the figures, today it includes, interestingly, the 10 largest banks in Europe. That's not so much of a surprise. Europe has typically led in these areas. But 2 weeks ago, Goldman Sachs joined, and that marked meant that 10 out of 10 of the largest banks in North America, including all the big Canadian Bay Street banks, are signed up. So 10 for 10 in North America, 6 for 10 in Latin America, and in total, 93 banks globally, accounting for 43% of global banking assets. So similar to the 90% of global governments or emissions of governments who are signed up, we have 43% of global banking. So I think these initiatives are at scale. This is no longer small green clubs. This is the mainstream we're talking about. They're getting started. They have very ambitious targets. You can read about them online. Of course, there's going to be a lot of work done. This is not about adding a green activity to a business as usual. This is strategically about changing how we do business, whether it's banking, investment, insurance, and every single sector of the economy, trying to understand how can we take carbon out of our business and still prosper in all the ways economically, financially, socially, and environmentally that we need to be a good corporate citizen of this transition.
Great, Eric. Thank you. I want to turn to Jane. Jane, BNP is a $500 billion asset manager. Huge. I suspect it's not easy for a company of that size to implement a real net zero commitment. What are the challenges, and how are you tracking it?
Sure. Great question. I mean, we had a little bit of a head start because actually in 2015, we already committed to progressively align our portfolios with the Paris Agreement. So if you think about it just from a big picture perspective, right, as an asset manager, we're a little bit reliant on what our clients also choose to invest in, but we as an organization also have oversight of kind of putting guardrails into place and choosing to launch or not launch certain types of product. So if we think about it from that big picture perspective, we can think about what we're investing in, right? So we have launched a number of new strategies, the Energy Transition Fund, the Ecosystem Restoration Fund. We have, kind of structured decarbonization across all kinds of indices. We have a new net zero aligned fund, and our kind of broad sustainable kind of plus range of different investments is growing, 4 or 5 times more quickly than our broader kind of mainstream range. So we definitely see a lot of interest from clients and investors to kind of allocate money towards sustainable solutions. We also divest from certain things. We have very, clear structured policies. Sonia earlier mentioned as a corporate, from a firm-wide perspective, we have a very stringent policy around coal, for example. So we avoid those types of investments across our different investment strategies. So you can invest in the green, you can divest and avoid the brown. And then in the middle, what's really, really important is engagement. is working with large companies and also with policymakers to advocate, to encourage them to transition at the pace that's required. So sometimes that's private meetings with companies. We're also very active members of different coalitions like Climate Action 100+, which is the world's largest collaborative shareholder engagement, where we engage with the largest 160 listed companies who are responsible collectively for something like 75% of global greenhouse gas emissions, collectively as their shareholders, often representing a very significant portion of outstanding shareholder capital. We're encouraging them to do three things: to have a net zero business plan, to have a climate competent board, and to disclose, their scope 1, 2, and 3 emissions in the context of TCFD, the Task Force on Climate-Related Financial Disclosures. So there is a very, unmissable wave of kind of shareholder engagement pushing companies, and not just pushing, but supporting companies to encourage them to make the transition and seize the opportunities that are available.
Thanks, Jen. Let's go to Herbert. Herbert, certainly your company is considerably smaller than Jane's. How's it going? How's the commitment go?
Yeah, I think we are sort of living in a continent where there's lots of aspirations and commitments towards net zero, but getting access to the finance is really the big issue, as I sort of alluded to earlier. So our focus is really on sort of helping to design and deliver public and private finance mandate alignment and getting that more catalytic private investment pathway in place that can ultimately fast track and scale private capital's participation in the green transition. And we're saying that these things are really going to be implemented through institutional investor, which is quite a new terminology, institutional investor public partnerships. And one such partnership that we're driving, the whole net zero platform, on a collaborative basis with asset owners across the continent and around the globe, is through a platform that we've established just to target this space called the African Green Infrastructure Investment Bank. And that's basically just realizing that the countries have signed up, but they need real access to this innovative finance. So we're taking an industry-wide and cornerstone investor approach through this particular platform. You have to realize that there's no leading purely green financial institution in Africa that can address and support, what is probably around $3 trillion worth of NDC investment project needs by 2030. That's the nationally determined contributions. That's $3 trillion of opportunity as we see it. And we know, by the same token, that Africa possesses an astonishing technical wind potential of almost 180,000 terawatt hours each year, which is enough to satisfy the entire continent's electricity demands 250 times over. So we've come together with the governments to do some of that important work, as well as an asset owner-led, platform that can really drive, this net zero agenda in a very strategic and constructive way. So the African Green Infrastructure Investment Bank is our vehicle to market, as it were. It's been seeded with about $5 billion from African institutional investors, African sovereign wealth funds, African pension funds, and it's anticipating about $20 billion will come from G7 and G20 investment allocators and peer institutional investors. We had to structure it in such a way that it has a certain defining character to it. So it's a unique institutional investor public partnership, borrowing from the models that I think we learned from Canada and we learned from Australia, some of the models that CDPQ and others took around the light rail and some of the other areas where they said PPP projects, and in that case it was pensions public partnership. So we are a combination of pension funds and sovereign wealth funds and insurance companies. So we've adapted that to an institutional investor public partnership model. So this particular platform is, really evergreen in nature around, driving that capital towards a net zero agenda across the continent. 100% commercially oriented in investment for commercial returns and taking some construction and operational phase risks. And again, we have to come and solve real market failure. So we actually took this model and took some of this initiative from the way that the British government established the UK Green Investment Bank before they exited and effectively sold it to Macquarie. So we've created this platform that we believe will continue to be a catalyst, not only our own capital, but But, as I mentioned before, a lot of this just transition conversation is now moving to private capital, and private capital is saying, well, how can we find a very practical way to align and get into emerging markets on a de-risk basis? And this platforms like this, we think, that are catalytic and able to, accomplish that. And we think that it has to be done on a sort of a global basis. So during the G7 meeting that just took place in Cornwall, hosted by the British government, we announced and formed an advisory board for this particular platform of the leading and the largest asset owners, collectively representing about $40 trillion of assets under management. So we certainly believe that if you can get the architecture right, or as Mark Carney calls it, collaborate on some of the plumbing, you can really, provide some kind of catalytic support that can, still deliver good risk-adjusted returns. So that's sort of the way that we're approaching this, John.
Well, it's interesting. You talked about the platform, which is a unique and creative way to get at getting us to net zero. I'm curious, working in Africa here, but are we seeing it from government driving the train on this, or are you seeing the private sector as deeply as involved as we've seen in the US and Canada and elsewhere?
Yeah, I think, as the governments are certainly there from an aspirational standpoint, but again, I mean, what is not there is not there, and that's this innovative finance. So what we are basically saying to governments, we have the capital and we have access to be able to catalyze and mobilize more capital, but we really need to create that hospitable, enabling environment, to be able to unlock that and de-risk it sufficiently so that it represents, a good risk-adjusted return opportunity for our capital. So you're hearing a lot of governments now really following the institutional investment community and private capital in quite a collaborative way and collaborative spirit. So it's an interesting dynamic. And I think a lot of that has been precipitated not only by the climate change and the net zero agenda, but of course, it's so fundamental for our post-pandemic economic recovery strategy. And I think that's really what's thrown us both together and enabled us to provide some leadership as the institutional investment community.
Well, since we have you, and I don't want you to hog the whole conversation, but if you can answer this next question fairly quickly, Herbert. One of the questions our session promised to explore is, do investment strategies need to change to meet the net zero targets? Can we reproduce the current model to new types of projects and companies? What do you think needs to happen?
Well, the way that we're looking at this is, which sort of touches a little bit on the point that you just made, and we've heard it said in many different ways, but the way we simply say it is, look, world governments and global development finance institutions recognize that there is no single pathway that can be met to net zero or to meet the SDGs and the Paris Agreement infrastructure and energy multi-trillion-dollar financing gap for bankable green transactions and the real transition without exponentially increasing the scale and the speed of global institutional investor allocations that can be rapidly deployed and perform at the project and the asset level. So for us, I mean, really, we're focused on, again, helping that effort by establishing a conducive legal and regulatory framework to deliver for this 100 trillion plus pool of capital. We think that's absolutely key. And I come back and sort of repeat that phrase again. It's that replumbing of the financial system that is going to really make the difference here. So we've come together. I actually also chair the New York board for the CFA's Asset Owner Council. And we've collaborated now with the global law firm DLA Piper. And we're developing a draft global model law, in fact, which we're presenting on Wednesday during COP26. And this draft model law is a very specific piece of legislation that's going to be focused on institutional investor-public partnerships, as I mentioned. And it's really a future-looking legal and regulatory partnership framework initiative that supports the goals of Paris Agreement and the net zero for governments and institutional investors to do a few things. Firstly, to be able to mobilize private capital at scale. We don't think that enabling environment exists in its sort of optimal form at the moment. It also exists to be able, or the model law will basically focus on assisting and creating a pathway to be able to deploy capital at speed. deepen and green secondary and capital markets, and really stimulate and support innovative private sector project developers. We're currently operating in a market where it's for a far less value. We're seeing the PPP legal and regulatory framework, which is much smaller than the 100 trillion plus pool of capital. So there's no real legal architecture in place to be able to de-risk these investments at the present time, or create predictability. And what we're actually doing with this piece of legislation here, and this particular approach, recognizing that it's no longer business as usual, is to basically disintermediate some certain players, a little bit of social distancing from intermediaries that might basically disrupt the ability for our capital to be able to get straight to that large pool of NDC projects. So this particular approach, we're basically saying the governments that will be developing the nationally determined contribution projects should not have to be intermediated by development finance partners. We're simply saying that governments with with these multi-trillion needs for financing can work directly at a large scale and a programmatic level, subject to creating that hospitable environment for our capital to be de-risked and to be able to be deployed at speed. We can have that direct relationship as asset owners with government, so we can deliver on the mobilizing capital at scale. Because look, we all know that the capital is there. The question is, how can it be deployed in a predictable way, that is responsible and enables us to deliver our fiduciary responsibilities. So that's the way that we are approaching this, so that our capital can be deployed at speed through a direct relationship, through an architecture and legal instrument that doesn't exist today, even though there are many calls for let's mobilize these very, very large pools. But there's not a legal architecture for it to happen. So that's one of the ways that we're approaching this business unusual. So I hope that helps, John.
Yeah, that helps. Jane, let's come to you. Should these investment strategies change in order to meet the net zero targets?
Well, I think fundamentally, yes, because I think if we take a step back, we say even though, something like 90% of global emissions now are bound by some kind of net zero commitment, net zero by 2050 or beyond, if we take a look at the economy today, it's, less than a quarter of the economy today globally would be currently aligned with net zero, right? So we can't overnight have $130 trillion of financial institutions limiting their investments and their support and financing to less than a quarter of the global economy, right? So we have a transition. And so how are we going to fund that? How are we going to push that over what time scale? I think for us as an asset management firm, as I mentioned, we have our overall guardrails that we can put into place around what are we investing in, what are we avoiding, and how are we encouraging companies to transition, and what kind of products are we providing to our end clients, and what do their beneficiaries want in terms of how to allocate capital. So I do think that, if we look at the Canadian landscape, for example, as Eric mentioned, all of the large Canadian banks are now part of the Net Zero Banking Alliance. It's a smaller number of Canadian financial institutions, whether it's asset managers or asset owners. So I think there needs to be kind of more discussion about that in Canada. How do you think about that? In the European context, of course, where we're headquartered in France, we have a larger portion of financial institutions that are committing to net zero, but it's not yet something that the regulator per se is providing clear guidance on, right? And so some of you will be familiar with SFDR, the Sustainable Financial Disclosure Regulation, which is really, kind of turning over the European financial community in terms of all of the different rules, disclosure requirements, things we need to put into our prospectus in terms of how we're aligning with the EU taxonomy, how we're do no significant harm, how we're focusing on principal adverse impacts, all kinds of different specific things that have regulation associated with them and guidelines in terms of exactly what we should disclose. We're not there yet on net zero in terms of common definition, common framing. You have different investors using different calculations around, what temperature is a portfolio associated with. And, our insurance arm of BNP Cardiff has run, and we've published this through the last TCFD report as an example. You can take the same portfolio, use a different methodology, and come up with pretty significantly different temperature readings. So I think that, on the one hand, we have, an unquestionable level of goodwill, focus, and a lot of really smart people in finance who are now focused on this, which is fantastic, but more work to do in terms of coming up with common alignment, common terminology. We need to move the economy, but we also need to come together collectively to come up with the right kind of shared methodology that's science-led, that's credible, that we can use collectively to make sure that, that it's not all blah, 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 that we are actually being transparent and pushing towards the right outcome.
And Eric, you've been deeply involved in creating a lot of these investment strategies. How hopeful are you that a number of, whether individuals, companies, governments, are going to fall in line?
Well, we do believe this is about real change, and I would start by saying what Hubert is talking about. This is where change happens. This is where we're investing in new infrastructure, new assets on the ground, which are going to drive both climate stability, but also energy access to clean water, social empowerment, etc. So, but the real question is, how do we connect the 130 trillion that ostensibly has a net zero target to drive some of that capital onto the ground where people like Hubert can use it to invest it in good economic but social environmental outcome activities? Larry Fink himself mentioned a note of caution last week when he said we have a problem that a lot of these investments aren't necessarily going to be going to the places, particularly in the developing world, where a lot of it is most needed, and we need to have a lot of work to do to try to get the new instruments, to try to get the new enabling frameworks to allow capital to go where it can do the most good. I think two of the most important speakers or presentations last week during Finance Day. One was the Financial Stability Board, when they announced that the GFANs would report to it on a regular basis. So very importantly, these commitments will be reporting into financial regulators. And linked to this, we heard the UK government announce that UK corporates were going to have to start issuing transition plans. So the regulators are getting involved. But I think maybe the most important announcement last week was the IFRS Foundation announcing the establishment of the International Sustainability Standards Board, the ISSB, which will sit alongside the IASB, which is what sets accounting standards in most of the world. So that we're going to have financial reporting now alongside, we're going to have essentially impact reporting. And so I think in terms of what's going to change business strategy will be going forward, the expectation is that you don't only report on material risks and financial attributes, you also need to start reporting on what is the impact of your financing, both positive or negative. As we start to get increasing regulator oversight in terms of generating more positive impact, we get the pressures for the capital to start going to the Huberts in terms of the activities that can generate real impact on the ground. So I think this bookkeeping, the need to start understanding, measuring the impact we have with our financial products and services, that will start to change, start to drive strategic orientation as to say, okay, here we line up the dots between the high level intentionality or commitments to get to net zero and other sustainability outcomes, and what actually will drive impact on the ground.
Thanks, Eric. Jane, a lot of people are probably sitting here and thinking, getting to net zero is a wonderful thing, but, they're probably not fully convinced that a lot of the investments that would get us there are the kinds of investments that would return a really good return on their investments. How do you convince people that, your retirement is safe if you were to go down this road?
Yeah, it's a great question, completely fair question. I think it's important to think about, some of the near-term, shorter-term, more recent evidence, but also think longer-term, right? So if we take longer-term first, we know now there is indisputable kind of evidence and understanding that we have to move towards net zero to protect not just the planet, but the economy and society, right? And so that's a fundamental belief, and that is something that we collectively, as fiduciaries of, long-term stewards of capital, have a responsibility collectively to work on. So how do we do that in a way that also protects kind of shorter-term economic interests and investment outcomes for our clients? Of course, that's also incredibly important. And in economies, like Canada, that are more resource-rich, that have higher portions of their economies linked to these activities, of course, it's a more sensitive question. And of course, we have to think about the just transition and how we support different communities in effectively navigating that transition. I think it's a really important topic. It's something, of course, that's under discussion in Canada with some great examples so far. But I think for us, it's really been about identifying the highest carbon activities. We started first with coal in our very detailed coal policy, and kind of worked down from there. And it's about moving away from the darkest brown activities, and then moving, also allocating towards some of the new opportunities. And actually, our best performing strategy last year was our Energy Transition Fund, which really tapped into a lot of interesting growth opportunities from around the world. And we know that there is a lot of technology that's available today to be allocated and implemented at scale that provide enormous economic and investment opportunities. So I think, it's not without risk, and you need to have, well-informed teams that, are on the ground and really looking at these things very closely. But we're convinced that we can provide our clients with fantastic investment opportunities that are aligned with net zero, that will provide, strong and interesting returns in the near term, but also help us to, fulfill our obligations and help them retire into a world which has both a strong economy and a strong, environment in the longer term, which is also
I do understand, Jane, it's something that the company wants to do. It's made a commitment to do it. But have you also seen individual investors and others come to you to say, look, we want to be more responsible?
Absolutely. I mean, we have a huge number of clients that really want to understand this space. They want to understand the risks and the opportunities. And sorry, it's not even this space anymore. It's not investment versus sustainable investment. It's all converging, right? What we're seeing is, I think, global financial markets, whether it's banking, finance, investment, or the long-term, institutional investors, pension funds, sovereign wealth funds, who say, look, we need to understand risk at an asset level. We need to understand stranded asset risk. We need to understand the timeline associated with that. And we also need better tools to measure and understand. It comes to Eric's point around, TCFD, and understanding how a company's positioned on climate. We don't have enough reporting yet on things like Scope 3, which is really important. And we also have the newly launched TNFD, the Task Force on Nature-Related Financial Disclosures. And, I think another really important emerging reality is the role of natural capital in, facilitating the transition to a net zero economy. And I think that's another really interesting and kind of largely untapped investment opportunity when we think about the current opportunity to invest in sustainable agriculture and sustainable land, but also the future opportunity when we look at the role of sustainable land management as a future carbon sink. And that comes back to what I mentioned earlier around Article 6. And I think it touches on what Hubert was mentioned in terms of, this fantastic innovation that he's working on. Kind of institutional investors allocating to sustainable infrastructure and land management in emerging economies is such a big part of what's needed. And there are enormous barriers, right? We all know that. Anyone who's involved in capital allocation knows that. And I think figuring out how to de-risk that and provide more transparency is a really, really important objective.
Mm-hmm. Eric, I'm curious to get your take on how would you convince individual investors that this is something that's important to them, important to the future of the planet, and would also have some good returns for them?
I think there's many lines to take, but let me take the one that Jane introduced, this body of research called the Inevitable Policy Response, which basically says, if you're in a jurisdiction where there isn't a significant or a sufficient policy response today, that's actually not a reason to lean back and say, well, I'll wait for the price on carbon to come or other action before I lean into this space. There's the view that, if you look at the science, the science is not taking timeouts. So essentially, the inevitable policy response says that in every jurisdiction, there is going to be a policy response. There will be a price on carbon. However, the later it comes, the more brutal it's going to be in terms of stranded assets. So if you're in a jurisdiction which doesn't have a policy response yet, it's actually a reason to pay more attention, not less. And therefore, it's in your interest to actually, within your fiduciary duty, to actually say, I need to mitigate, manage my risks now. I need to assess that there will be a policy response coming, and therefore there is a good economic financial rationale to already be taking certain actions, which makes good business sense.
I suspect, Hubert, it's something that you're dealing with every day in terms of questions that you're getting from your clients and others. What do you tell them?
Look, I mean, we just are very fortunate enough to be, right at the forefront of trying to shape the policy, trying to really help clients understand and let governments appreciate that, this has got to be a very collaborative effort. And I think everyone really does appreciate and understand all of these different initiatives that we've seen happening just recently makes very clear that, there's going to be a very high price to pay in terms of, as we've heard from, both of our speakers here today, the stranded assets risk is quite astronomical. The damage that can actually, result on our economies and the world that we live in, our fragile planet, I think is becoming much clearer. That public awareness that translates into the members and of pension plans and the future generations, I think is, far ahead of what we give it credit for. When you sort of couple that with the fact that we're now, our own children, families and communities are actually going to be the generation that's going to be most affected by that, and the decision makers of now and tomorrow. I don't think we're pushing against the closed door. I actually think that we're not sort of really appreciating that there are more Gretas around us, that are actually investors and members of the pension plans and the investment community. So I think it's really the work for us is less about convincing and really more about creating the de-risking instruments and mechanisms to ensure that we can make these investments and grow the market appropriately in a responsible and sustainable fashion.
But we just have 2 minutes left, but I want to see if I can wrap up with you since I've got COP27. Africa,
yes.
An area that you're spending a lot of time focusing on. And there are a lot of issues to be discussed, some of which we've talked about earlier today. Is the continent ready?
Well, I think, the reality is we have to ask ourselves, is the world ready? Because I personally believe that the continent is ready because there's leadership on this issue. We started working on COP27 over a year ago on the understanding that even though we didn't know which country was going to be hosting the global platform, for the UN to host the COP summit, we knew it was going to be in Africa. So we've been working with the Institutional Investor Group on Climate Change, Climate Action 100, International Federation of Sovereign Wealth Funds, African heads of state, policymakers, ministers of finance, the G20, the International Energy Agency, all focused on the agenda that we think that we can bring. And we know that there are going to be many pieces that we're going to have to pick up from COP26, but we know that the COP26 agenda has been sort of driven, and accepted by many of these same players that I've mentioned. So we're already fortunate enough to know that there's going to be continuity with a number of these players. But John, one of the key things we really want to see at COP27 is that private capital comes to the table, and provides leadership, and we think that that's already very, very well situated. As I mentioned, on Wednesday, we're going to be having a big discussion with the International Energy Agency, the Global Infrastructure Hub, the International Federation of Sovereign Wealth Funds, and the International Chamber of Commerce. And it's called The Road to COP27. So the planning is in place. The only real difference is that we believe that it should be much more of an institutional investor-led COP, as distinct from perhaps what we've seen around COP26, this current COP, which is much more the finance community. We believe that it's not just about private capital, greening our portfolios, but we think those portfolios can be much more strategically directed towards greening the real economy. And I believe there's going to be lots of great announcements in that respect.
Thank you, Eric. Thank you, Herbert. There's so much to discuss. And I want to thank you, Eric and Jane, for a really enlightening discussion. We'll see you at COP27.
Doing business in Africa. You can't afford to be without Africa Investor.